Hey everyone, it's Arnold here. A lot of companies are going public these days. Just look at the last year alone, Airbnb, DoorDash, Snowflake, all went public. Typically, they go through a process called an IPO, an initial public offering to turn private company into a public one that's offered on the public markets. This means that they're going from a private company owned by private shareholders and turning into a public one that is traded on the markets. So before you can't buy an Airbnb stock, for example, but now you can after an IPO. However, a lot of companies are going public through a SPAC as opposed to an IPO. Virgin Galactic, 23andMe, and the rumor of Lucid Motors are all examples of SPACs that have purchased these companies to go public. In this video, we're going to talk about how IPOs generally work, what is a SPAC, and whether or not you should look into investing in a SPAC. Before we get started, it would really help me out if you click that thumbs up button. It would really help me out in terms of producing content that's right for you, and thumbs down so I know to do better in the future. With that, let's get started. So how do IPOs generally work? So an IPO, as I mentioned, is an initial public offering where a private company would go public. These companies would issue new shares to offer to the public that you and I could buy. Private companies are generally reserved for private investors, possibly VCs, venture capitalists, or people that have a lot of money. So IPOs generally must meet the requirements by the SEC, the Security Exchange Commission, so it's extremely regulated. Typically, there's a S1 filing to show the inner workings of the financials and the business plan and where the company is going forward. And more often than not, an investment bank would be involved, such as Goldman Sachs or JP Morgan. Companies would hire investment banks to market the company, gauge market interest, and price the IPO, in addition to several other things that only investment banks would do. So this is an IPO, generally how many companies have gone public in the past. Now, what's gaining popularity is to go public through a SPAC. There's a sort of SPAC bubble, they say, that's happening right now. So SPAC stands for Special Purchase Acquisition Company, also known as blank check companies. So essentially, these companies have no operations of their own. The sole purpose of these companies is to raise capital, raise cash, with the purpose of purchasing an existing company in the future. These companies that they purchase are generally high-risk growth companies that generally would not want to go through a typical IPO process. Compared to regular IPOs, SPACs actually outpaced them in the last year, raising $73 billion, according to Goldman Sachs. Generally, SPACs are created by high-profile individuals or hedge funds that ride the name of their reputation such that people would invest in them, to believe in them, to purchase a good company in the future. Examples of such individuals are the co-founder of Shake Shack, Richard Branson, or Chamath Palihapitiya. Essentially, they create these SPACs and hope that you, as an investor, would just throw money at them in the hopes that they would purchase a good company in the future. So generally, these SPACs will go public for anywhere from months to years, and people would invest in these SPACs that does nothing and hope that they would purchase a good company in the future. An example of which is that a SPAC recently purchased 23andMe, and this was owned by Richard Branson. Another example is a SPAC called CCIV that is rumored to purchase Lucid Motors in the future. Chamath Palihapitiya also has a SPAC publicly traded on the markets, and who knows what he'll buy. So the question is, should you invest in a SPAC? Well, these SPACs are generating increasing investor interest, speculating that these SPACs will make a good purchase decision in the future. Although it's really increasingly looking like a bubble within a bubble, you're just speculating that these would buy good companies. According to the Edge Consulting Group, after these SPACs buy a company, they generally lose money, and within the next 12 months, they lose even more money. Honestly, this reminds me of the dot-com bubble where people would buy things like Pets.com, hoping that this random pet store would generate billions and billions in revenue in the future. You're really just guessing and hoping and speculating that these SPACs will make a good decision and make a good purchase and do well financially in the future. So in conclusion, these SPACs are highly risky, looking increasingly like a bubble, but if you believe the name behind these SPACs, such as Richard Branson or Chamath, then maybe it's worth investing in. But generally, I would say most SPACs are probably garbage. So that's it, everybody. That's a quick little bit on SPACs, special purchase acquisition companies, and whether or not you should buy them. Again, do your own research, look into them, look into the name behind them, and see if it's something that's right for you. With that, thank you for watching. Please subscribe and like this video if you like this content, and I'll see you in the next video.